European markets rally on Monday as the first round of French Assembly elections points to a hung parliament and policy gridlock. Welcome to Market Insight, I'm Ramzan Karamali. Well, markets concern for a potentially high-spending national rally government in France eased today. Banking shares led the surge in French stocks and the premium investors' demand for holding the country's bonds fell. But has all uncertainty been eliminated? Well, to help answer that and more, I'm joined by Kathleen Brooks, Research Director at XTB. Kathleen, thanks so much for joining us. So what have you made of today's reaction and also last week's moves? What should we expect in the days before the next round of voting?
Well, I think obviously Marine Le Pen won the largest share of the vote. She's done very well, certainly since 2022. She's nearly doubled her vote share. However, she didn't quite do as well as the market expected and some of the opinion polls projected. So some of them expected her to win 36% of the vote. She ended up getting 31%, which translates between 230 and 280 seats. In the French Parliament, you need to get 287 seats to form a majority. So it does look like it could be a hung parliament. The other thing that could thwart her is actually an alliance of the centrist party, so Macron's central coalition, combined with the left-wing alliance. They've said that they will stand candidates down in order to block Le Pen's RN party from getting power. So she's got a real tough job in the next week, and it's not clear that the National Rally will actually be able to form a majority at all. So there's a lot of uncertainty around the actual outcome next week. Now, we have seen a rally in markets. However, what we haven't seen is a complete recovery from all of the losses, because there's been a huge loss, 20% for some of the French banks just in the past month or since that election was called on June 9th. So we haven't seen it all come back, which suggests that there's still a political risk premium attached to French assets. And we think that will be the case until we know who's going to be in government and also what their policies will be.
Indeed, and so more volatility ahead.
It does look like that for sure. We're seeing a bit of a recovery rally now. But I think that, even if Marine Le Pen doesn't get to form a government now, she still has a huge amount of support. And some people say, well, that could only grow. So you're really kicking the can down the road. She could come back in another few years. She could certainly contest the presidential election in 2027. So she's not going to go anywhere. So I think that political risk premium, people's eyes have been opened up to the fact that you've got potentially far-right government, a high deficit in France. Those two things tend to cause the markets a lot of volatility. So we might continue to see that political risk premium, as I said, get attached to French asset prices.
Now, we've also had some PMI data out today, and yet again, Eurozone factory activity declined in June. Also, we've just had German inflation come in at 2.5%, which was a bit lower than expected. So does this all give the ECB more reason to cut rates again sooner rather than later?
Well, I think the decline in the PMI, manufacturing PMI in the Eurozone has been in contractionary territory for 25 straight months. It's led very much by Germany, which has a reading of about 43. So Germany is really dragging that whole block down, but there's also pockets of weakness elsewhere. Even though Italy did improve, they're still in contraction territory. So it really does show, I think, even though some of the respondents were actually quite positive on the future and the outlook, there was a reacceleration in the decline in new orders. So it looks like we're not going to see a pickup in Eurozone manufacturing activity until maybe after the summer. That's pretty typical because a lot of European factories actually closed for August. But I think it still is worrying nonetheless. We have seen inflation pressures or that disinflation impulse return to the Eurozone. But I think what we do expect at the moment, the market is pricing in about a 70% chance of a September rate cut. So that's still pretty high. And there's certainly a reason. If you're a manufacturing company in Eurozone, you definitely want a rate cut, put it that way.
Now, turning to the UK, we got an unexpected rise in house prices last month. That's according to the Nationwide. Do you think this is just a blip, though, considering how high borrowing costs are here?
Yes, and I think there's possibly some anticipation that we're going to get a rate cut as soon as August. And so that's leading people to maybe take another look, maybe think about buying a house right now because borrowing costs will fall. And we do know that a number of mortgage providers in the UK have actually reduced their borrowing costs. So right now there's about a 65% chance of a rate cut priced in for August or for next month for the UK. So there's high hopes there, and that's really feeding through to this house price data. I think if we do get that rate cut, and if we do start to see, maybe our inflation rate is back to 2%. So if there is expectations that there'll be further rate cuts, maybe in the coming months, from the Bank of England, and that could also boost the housing market. But we've seen wide variations. Northern Ireland, parts of Scotland doing very, very well, but then other parts of the UK seeing declines in prices. So it's not a blanket increase.
Now, on the corporate front, we had a pretty interesting deal. Boeing agreeing to buy back Spirit Aerosystems for $4.7 billion, and Airbus moved to take on the supplier's loss-making Europe-focused activities. What do you make of all of this?
Well, I think there's two ways of doing it. I mean, the real focus for Boeing at the moment is to improve the safety of the manufacturing process. So bringing Spirit back on board is one of the ways of measuring that. They had split up in the 2000s, so it's really kind of coming back together rather than just an outright purchase. I think the other thing is that Spirit, Airbus is going to take on its own business from Spirit, and it's probably wanted to do that for a while. It's also going to get compensated to the tune of about 500 million from Boeing for this, with the whole deal costing Boeing about $8 billion, and that includes debt from Spirit. So it does look like a bit of a dud deal in some ways for Boeing. However, it is designed, I think, more with a safety focus, because Spirit Aerosystems, they're the ones that design the body of the 737 MAX jet, and that's obviously come under a lot of scrutiny. It's been involved in a lot of accidents. So Boeing's been under a lot of pressure to really focus on the security of and then the safety and the health and safety measures within its manufacturing process, and this is one measure to do so.
Kathleen Brooks from XTB, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.